Welcome to Hotel Investor Marketplace, produced by Hotel Brokers International. I'm Tony DeGeorge, President of Hotel Brokers International and President of Green Canfield DeGeorge Ltd., a hotel brokerage consulting firm located in Clearwater, Florida. The Hotel Investor Marketplace is designed to provide today's hotel owners and investors with the most current industry information and an opportunity to view recent listed hotels. While everyone is getting settled and comfortable, we'll start highlighting a few of our HBI member listings on the screen, and I'll share a few items with you. Hotel Brokers International was founded in 1959 and is the leading hotel sales organization with a membership of 50 hotel brokers specialists. HBI members have successfully negotiated more than 10,000 hotel real estate transactions and annually accounts for approximately 48% of the mid-market and economy hotel sales in the United States. If you'd please visit us at hbihotels.com, our website, you'll see this, which will be posted later, and also our other listings. If at any time during our webcast you have a question, just click on the Ask a Question button found on the gray bar located at the top of the webcast player. Type in your question and submit it. We'll answer as many of those questions as time allows. We want you to also rate us. You can rate us by clicking again on the webcast rate button, which is found in the gray bar located at the top of the web player. Later today, this webcast will be posted for on-demand viewing at hbihotels.com. Today, it's my pleasure to welcome Rochelle Stone to our webcast. Rochelle is the president and founding partner of Starker Services, the nation's oldest, largest, and most experienced independent qualified intermediary firm. Starker has successfully completed thousands of exchanges each year. Rochelle has been active in 1031 exchange industry for over 20 years and is a national recognized speaker. She also teaches exchanging and investment techniques to investors and professional groups. Rochelle, welcome to our webcast.
Thank you, Tony. I look forward to working with all of you today for the next 45 minutes or so, and hopefully I can give you a good overview of what the current marketplace looks like from an investor's perspective and how the 1031 exchange can be used as an investor's tool. Let me begin with a question, and that is, why should we discuss exchanges? And the answer is because it's time. Keeping in mind we're a national company, we've been doing this for over 20 years, we've seen both buyers and sellers markets. And in summary, investors are back. We've seen a lot more activity even in the last couple of years than we have for some time now. So our objectives today then are to talk about 1031, what's new, review the basics, and also to talk about some of the current market challenges and how we can solve some of those challenges by using the 1031. In terms of what's new, it's no surprise to any investor that tax rates are up, and that includes the new Medicare surtax of 3.8%. So taxes have never been higher for investors. And the other complement to this is that taxing authorities have become very, very aggressive. As I said, in over 20 years, we've seen what the IRS and state taxing agencies are looking at, and they are very aggressive, and I don't think it's going to be a surprise to anybody that states and the federal government are looking for money. So with the current market challenges, we have ways to solve problems, to maybe give investors more opportunities, and we're going to cover some of those steps and then give you two case studies. These are actual transactions that occurred in our company that maybe will give you some ideas for your next investment strategy. What is Section 1031? It's a tax code that says that no gain or loss will be recognized on the exchange of property held for productive use in a trade or business. And essentially, it's investment. It's investment exchanged for investment. Now, how do you explain that to somebody? I think it's just easier to say it's an IRS-authorized tax savings technique, or it's a tax thing. It is legal. It is legitimate. Many years ago, I was giving a class on exchanges to a group of investors, and at the end of the class, I said, are there any questions? And one person raised their hand and said, I have a question. Does the government know you're doing this? It sounds too good to be true, but it has been part of the tax code since the late 1970s. It's not a swap. Many investors think it means I have to find a property to swap my property for. It's not that either. It's a way to make a taxable event tax deferred if you follow the guidelines. So let's talk a little bit about what the guidelines are. First of all, as an investor, like-kind property is what you have to exchange for. And this is probably the most misunderstood part of the tax code. Many people think if I'm selling a rental house, I have to go back into a rental house. If I'm interested in motels, I can't go from commercial property into a motel or a hotel, or if I have raw land, I can't go back into improved property. And it's simply not true. This is one of the most generous sections of the tax code. On your screen, you'll see examples of like-kind property: rental houses, bare land, office buildings, motels, hotels, apartments. All of these are like-kind to each other. They can all be exchanged for each other using a 1031 tax-deferred exchange. So if you have raw land and it's not producing income and you'd like to exchange it into something that does generate some income, that can all be done through 1031 exchange. It's an extremely powerful tool for investors. Now,
and
obviously,
Rochelle, if I may interrupt, just a quick question. When's a good time to sort of contact somebody like Starker? You guys should probably get involved maybe when they're thinking of selling their property rather than wait for the sale?
That's a good question, Tony. We have an 800 number, and it's a free phone call to call one of our counselors and say, I have a piece of property, I would like to sell it and move the money somewhere else. Will it qualify if I do? And then we'll talk to them about it, and we'll potentially say, you need to ask your accountant some questions. Here are the questions I would ask your accountant. But earlier is always better than later, because pre-planning makes it easier to make sure you follow the guidelines.
Excellent. So really, as they get involved in the idea of selling a property, it's probably best to call you people and say, here's what I'm doing. What is the best route that I should take? Because, I know we've just looked at some of the opportunities as far as like-kind. Some of the things that even are explained to me that, people can take and take a piece of raw land and then exchange actually from that into a hotel, or even a hotel into a piece of raw land. So we've worked with your company and have experienced that ourselves. So I know it's very important to do it up front and, as quick as possible before even if the process begins as far as selling the property.
And that's a good point, Tony. Once in a while we get a call from somebody who's already sold their property. They haven't touched the money, and they ask us if it's too late to do the exchange. We hate those phone calls because once you've sold, if you didn't set it up correctly, you don't have the option to defer the taxes. It is now a taxable sale because you sold a property and you had constructive receipt of cash or the ability to touch the cash. That's part of what we're talking about when we talk about the strict IRS guidelines. Remember, the Internal Revenue Service is the part of the government who gave us these rules, and they expect them to be followed. So let's take a minute and talk about some of the rules. When you sell a piece of property, if you are doing an exchange, you have two time frames you must be aware of. From the date of closing on the sale of your property, you have 45 days to identify a replacement property or properties. And there are two rules for identification. The government says that if you sell a piece of property, you can identify up to 3 possible replacement properties with no limit on the value. So if I sold a property for $500,000, I could identify a property for $500,000. I could also say, if that doesn't work, I'm going to buy this property for $700,000. And if that doesn't work, I'm going to buy another property and it's worth $800,000. You must then purchase one of the properties you identified by the 180th day from the closing of your sale side. That's called the 3-property rule. It's the most common rule used by investors because it's fairly easy to work with. Once in a while, an investor will call us and say, I'm selling a very large piece of property and I want to diversify, so I'd like to buy 20 rental houses, for example. In that case, the 3-property rule would be difficult because you want to identify more than 3 properties. So then you would follow the 200% rule, which says if I'm going to identify 4 or more properties, the total aggregate value of all of those 20 properties, for example, cannot be worth more than 200% of what I sold. So let's go back to the $500,000 sale. If I'm going to identify 20 properties, I double the value of my sale, and the total value of those 20 properties cannot be more than 200%. Both of these rules are government regulations. They don't necessarily make sense from an investor's standpoint. They're just guidelines that we have to follow, and we help clients through that process in terms of notifying them when the 45 days and when the 180 days is. Those are the time frames for the exchange. Another strict rule, to not have any taxable event, you have to go into property that's equal or greater in value, and you need to move all of your equity across and replace your debt. Let me show you what that looks like. We call it the Napkin Test. It's just a name for a very short test to see if your exchange is going to be totally tax deferred. You can see in this example the sales price is $260,000. I'm buying a piece of property for $400,000. I've gone across or up. There's nothing taxable happening there. My equity after I pay off my mortgage and my closing costs is $200,000. The purchase property I'm going to put the $200,000 into, no debt, no cash in hand, so there's nothing taxable happening there. The mortgage was $60,000. I'm buying a bigger property, so I'm going to have a larger mortgage. So I've gone across or up in mortgage. There's nothing taxable happening here. So this is a totally tax-deferred exchange. Let's say I went from a property worth $260,000 to one worth $250,000. Many of our investors want to downsize a little bit. There's nothing wrong with that. It just means they are going to have about $10,000 worth of a taxable event of some sort. It's a partially tax-deferred exchange. What does this look like when you're the investor? In the top box there, you'll see you've got a seller who becomes an exchanger because they get a qualified intermediary like ourselves involved. We produce all the paperwork the IRS requires. We send it to the closer and tell them that, yes, this is a sale, but it's a 1031 exchange, so it's going to be a tax-deferred sale. The government allows the intermediary to be assigned into the contract at the closing table by having the buyer and the seller agree that we're part of this closing. The deeding is still going to go directly from the seller to the buyer of the property, and the cash is going to go to the intermediary. In essence, if any of you have worked in a Roth IRA situation where you've put money in without paying taxes on it and it sits with the IRA holder and you don't pay taxes unless you touch the money, and it can be rolled over to a different IRA holder as long as you don't touch the money. This is a very similar situation, but it's real estate, and we act as the Roth IRA holder. We're producing the documents the government requires. We're protecting you from the taxable event because you don't have constructive receipt of the cash. This slide is the first step of selling the property. Second step, we'll finish with the seller of the original property saying to the intermediary, Starker, I have found a replacement property. Here's the closing. Would you please use the cash you're holding on my behalf to buy that property and have it deeded to me? The intermediary makes sure that the money is wired in to the seller of property B. We're assigned into that contract, so we're part of that closing with all of the necessary paperwork. And seller B will now deed the new property to our client to finish the exchange. The exchange is over and the client has moved all of their money across without touching the cash or having control of it, and this is what the government considers a tax-deferred exchange.
And
Let's
just
talk a, sorry?
Oh, that's okay. I was just going to say, and just we happen to have a question, just to sort of put the question to work in that diagram that you had. If you were exchanging between two properties, the intermediary would be the person that would be talking to both of the sellers and would do exactly what you said, except there would be the two properties or the other number of properties that they wish to do. Is that correct?
That's absolutely correct. So each time our client, who's now the exchanger, says, I have found a property I want to purchase, we send instructions into that closer, and it may be several properties in several different states. And we would have a relationship with each of those closers, get each of those sellers' signature at the closing table. So this is all done at the closing table. We work directly with either the closing attorney or the title company.
And just to further that, as I remember, you guys have an actual clause that you like included in the purchase agreements, expressing that a 1031 will be done, and you actually are able to supply that information to sellers and buyers. Is that also correct?
Very, very much so, Tony. What we want is when a client is anticipating doing an exchange, we tell them to have some wording in your purchase and sale agreement. It can be done through an addendum, or some states have it actually as a clause, a check the box clause in a contract. And all we're doing is notifying the buyer when you're selling the property that the seller intends to do a 1031 exchange, and they'll be asked to cooperate by signing an assignment agreement. The intermediary cannot change the timing on the closing. We can't change any of the terms. Nothing will change for the buyer. We also suggest that wording is on the buy-side contract, notifying the seller of the replacement property that this is part of the 1031 exchange, and we ask them to cooperate by signing an assignment agreement, which we provide.
Excellent.
Now, one of the common myths in the marketplace, we've come off of, as you know, anyone who's been in investment real estate, we've seen very good markets, we've seen average markets, we've seen terrible markets, and in some parts of the country they are still trying to recuperate from the terrible market that a lot of areas experienced back in 2005, 6, 7 when values went down. Sometimes clients think that if they had no profit, there aren't any taxes, so they can simply sell the property. And that's something to be very careful of. Most investors understand the difference between profit and gain, but I think we should just quickly discuss that again. When I buy a piece of property, in this example, my original cost of the property was $495,000 in the left-hand margin. Above that is going to be my current market price. I'm selling for $545,000. So I've had gain from appreciation of $50,000. That's profit. My adjusted basis in the property in the left-hand margin lower column is $475,000 because every year that I own investment or income-producing property, I get to take depreciation. It's a benefit of owning real estate. But what that does is it adjusts my basis or book value in the property down. So now I also have $20,000 worth of gain from depreciation. And that gets taxed at a higher rate. Now in this example, the client has made profit because they're selling for more than they paid for the property. But what about this? This is a real trap. In this example, the client bought for $495 in a market that maybe just flattened out or even went down. It's finally come back up to where they paid for it, so they're ready to sell, thinking they haven't lost any money. So they sell for the same price that they purchased for. There's been no appreciation, so they're thinking no profit, no gain. But in reality, in this example, they've held on to the property for 5 years. They've taken $10,000 a year in depreciation. They actually have depreciation recapture of $50,000. And that's recaptured at roughly 25%. It's one of the highest areas of tax. And then most states will step in if you sell a piece of property and charge a state tax. And we picked an average of 6%. It can be higher. So in this example, the client has not made any profit, and they have total taxes due of around $15,000 plus. If they had done an exchange, they could have gone into another piece of property that hopefully would give them better cash flow or was in a better area or suited them and gradually work their way out of that. So that's the difference between profit and gain.
I have another question. It's sort of off topic a little bit, but
sure.
How are deposits on the basis of a non-refundable deposit? At certain points, we become 30 days or whatever from closing, and we have non-refundable deposits. Now that money is non-refundable, will that interfere with anything far as a 1031 exchange?
A good question, Tony. When a non-refundable deposit, if it comes to the seller actually has control of it, we suggest to them, after they double check with their accountant, that they get that back to the closing table, because in reality that's part of the sales price of the property. If they keep it, it's actually a taxable event for them when the property sells. Some clients, after talking to their accountants, will actually wire to a trust account we set up for them that non-refundable deposit, so it sits there and becomes part of the exchange proceeds when the sale occurs.
So that's probably the safest thing for someone to do is to allow those funds to be held by Starker, and that way, as long as they don't touch them, is what I'm hearing, then it's okay. Is that right?
Right. We don't want them to have constructive receipt of the money. The IRS doesn't even care whether they touched them. It's if they have the ability to touch them. So when a client's going to have an earnest money that's going to go non-refundable within 30 days of closing, we suggest that we get assigned into that contract, we set up their trust account, and we have the buyer wire the money directly into that account. And by the way, our company will only hold money in a qualified escrow account for a client, which means the client's account is used one time, it's set up for their exchange, it's closed once their exchange is over, and they are a co-signer on the account. So it's our account, we're signers on the account, it's set up under Starker Services for the benefit of, in trust for the client. So it protects the client from the IRS, but it also, we can't buy the wrong property or send money out of the account without the client knowing about it.
Excellent. I appreciate you answering that.
We've talked about the essential elements of an exchange. It's a tax thing, strict codes, equal or greater value, profit and gain are not the same. Let's talk a little bit about, start getting into some case studies. I want to maybe give you some examples of ways that problems were solved we speak to thousands of people, and some of the trends we're seeing is we're hearing more clients say, we're having trouble finding suitable property. We would sell, but we can't find something we like better. Or we found something we like better, but we have to close on it because we can't get ours sold fast enough. So what I'm going to do is talk about two more sophisticated types of exchanges, not so much to teach you how to do them, but so that you are aware that this is an opportunity to maybe have a transaction happen that wouldn't have happened otherwise. This is an actual case study that we did, an actual client. I changed the name, obviously, because we're for privacy, but we'll call it Axis LLC, and they're an investor and they own hotels, and they get an unsolicited offer to sell land. There is a typo here, and I want to apologize. I didn't realize I inverted a number. Instead of $2.1 million, it was actually $1.2 million. They had some land that they had thought they might develop. They decided against it. They weren't as happy with the area, and then they got an offer for 1.2 on the land. Well, they have a lot of gain because they'd owned the land for quite a while. They couldn't find anything to buy. The agent knew that there's something called a construction exchange, and I'm going to explain that in a second. So the agent went out and found a site for a new hotel that was nearer where the client had other holdings, and it's in a better area in terms of what the client was looking for. But the list price on the new site was only $450,000. Well, we know from our previous Napkin Test that if I go from $1.2 million in property into a $450,000 lot, I've gone down in value by $1.650, and that would be taxable. The other thing we know is the IRS does not allow a taxpayer to add value to a property that they already own and consider that part of the exchange. So the value has to be there during that 180-day period before the investor can take ownership of the new property. It's a little bit like a horse race. They look at where your nose is at the beginning of the race, and they look at where your nose is at the end of the race, and what happens in between has to mean that the client has no control of funds. The intermediary can control funds. So they have something in the tax code called a construction or improvement exchange that the intermediary can actually be the party that buys the land, again, by going into the contract on that $450,000 lot, and we can spend the exchange money to pay contractors during the 180-day period to try to get the exchange balanced. Let me show you how that worked for this client. We bought the piece of land for sold the piece of land for $1.2 million. We purchased the lot for $450,000. We actually go on title to it as the intermediary. We begin the building. The client who started the exchange is actually working with the contractors. They are our manager. So they run the building project. They have the contractors submit invoices to us. We don't pay the contractor until the exchanger has read and approved what's going to be paid. In some cases, the clients have us send the contractor's check directly to them so they can hand it to the contractor when they're happy with the construction. And we continue to build for up to 180 days. In this example, we went from $1.2 million worth of land into a lot in the build-to-suit with $750,000 worth of improvements. And by day 180, we deed a $1.2 million property back to the exchanger. So the exchange, you can see, is balanced. They went out of $1.2 million. They went into $1.2 million. So there was no constructive receipt for them and no taxable boot. In this example, the client continued to build. They hadn't quite finished the new building, but they had balanced their exchange. That's the important part. Any questions about that?
I don't hear any questions on it. I actually have a question. So if the building, what I'm learning here today is that you don't have to complete the building like in a hotel transaction. You could only have the shell of the building completed, but then continue with your construction once you're balanced to finish the hotel.
Exactly. And that's not uncommon, because particularly when you're dealing with a motel or a hotel, those are large structures. It's impossible many times to have the whole site completed within 180 days. And we have to be a little careful here, because you can't order $50,000 worth of lumber and consider that real property. It has to be lumber that's attached to a foundation, so it must be considered real property by the time the exchanger takes over the site. So you do have to be aware of those time frames, and of course getting permits and getting plans approved, that can be quite time consuming. So we suggest to the client that they try to get as much of that done ahead of time before they complete the sale of their property. I don't know how many people have struggled through planning commissions when you're on a short time frame, or we had a woman that wanted to do a build-to-suit in Portland, Oregon. Well, it never snows in Portland, Oregon, and the day the heavy equipment moved in, it started to snow, so it slowed her down because of the weather. So then the race is to try to get as much done as possible.
We do have another question that's an interesting one. Does the partnership have to be the same partnership that owns the land has to be the partnership that builds the property, or can you, as the owner of the land, contribute as a partner to the building?
I'm not sure I understand that question, so I'm going to try to answer, but if I don't answer, let me know. The ownership must be the same all the way through the exchange. The taxpayer who owes the taxes when they sell the property must be the same taxpayer that finishes the exchange, buys the lot, has the improvements done, and ends up on title at the end of the exchange. And many people will use an LLC because they've become very popular. They do give you some protection. And they say, can I change the name of the LLC on the new property because maybe the LLC is named after, it's named after the project itself. And that's fine, changing a name, as long as the taxpayer ID number is the same. But if the IRS sees that the taxpayer actually changed during the exchange, that's a problem. That means that you've killed off the taxpayer who was doing the exchange, and so they didn't finish, and that would trigger the taxes. Please let me know.
So also, if you had a partnership and they were building a hotel and one of the partners wanted out of the partnership, would that affect the exchange to his portion or the entire portion?
And that's a very good question. That gets complicated also, and this is something we would discuss with a client. A minority share partner who wants to get cashed out isn't necessarily killing off the entire partnership. A majority partner who wants out, for example, 75% owner wants to get cashed out, and the other 25% partner says, well, I don't want to do that because I don't want to pay the taxes. Well, you've just killed off the controlling share of that partnership, and you can't have a partnership with one person. So that would be a dramatic impact. It would cause problems for the whole exchange. Possible solutions. We have seen partnerships finish exchanges by buying more than one property. They'll buy two different properties. And then after they have seasoned the investment for a while, a period of time, probably a year, maybe more, depending on what their tax counsel says, there are ways to distribute assets of a partnership back to the individual partners without triggering the taxes. But be very, very careful about what we call a drop and swap, because the government is looking for that, and that's where you change the ownership right before you do the exchange, which means neither partner has a holding period, because remember, this is all for property held for investment, which is generally a year or longer. or killing off a partnership right after you buy a building and distributing assets, because then the partnership has no holding period. So that can cause an exchange to fail.
Excellent.
Partnerships, okay, one more point. Partnerships can also own as tenants in common. So sometimes we have a partner who had land, did the exchange into a piece of land to balance their exchange, and then they have a partner who's a developer who comes in. So there are two partnerships that now own the improved property. But each partnership must balance their individual exchange. Let me talk about another situation that comes up fairly often. What if a client has to purchase first? Once in a while, we get a client who calls. They say, I have a buyer for my relinquished property, but if I don't close on the buy side, I'm going to lose the transaction. Well, an intermediary can go on title to do a construction exchange, but an intermediary can also be used to perform what's called a reverse exchange. And a reverse exchange is where a purchase has to occur before an actual sale has occurred. I'm going to talk about that, sort of walk you through an example of what a reverse looks like. It's a far more complicated type of exchange, but it is a problem solver. And then talk about an actual case study where we combined a construction and the reverse exchange to solve an investor's issue. In a reverse exchange, there are actually two types of reverse. And one is where the intermediary is used as an accommodation title holder, that's the government term, to buy and warehouse the new property, the replacement property, for up to 180 days to allow the client to get their property sold. Because remember, you can't move money into a piece of property that you already own. So you can't just go out and buy a piece of property and then later sell a property and move your money across. But you can, under the safe harbor reverse regulations under the code, use an intermediary to do that for you. The second type of reverse is where the intermediary is used to be a temporary buyer of the relinquished property. So we would buy and go on title to the property being sold, which frees up the cash to purchase the replacement property, and now the exchanger goes on title to the new property. Now the exchanger has 180 days to get the relinquished property that we're on title to sold to an actual buyer. The issues with reverses. The first thing we say when we get a call from a client saying, I have a piece of property I want to purchase, I haven't sold yet, I want to do a reverse, our first response is, no, you don't. Do everything you can to avoid a reverse because they're complicated, they're more expensive, but they are a problem solver, and I want you to know about it because it can help you find a piece of property in a seller's market where it's difficult to find the product you want. You have to use an accommodation title holder for the safe harbor. You can't have your neighbor go out and buy a piece of property. Your mother can't do it. You can't use a related corporation to go buy a piece of property and then exchange into it because you can't buy from a related party. So that's why the accommodation title holder designation was set up under the code. The exchanger is allowed to make and guarantee the loans on either the buy side or the sale side, and I'll tell you why that's important in a minute. The exchanger will also lease the property from the accommodation title holder. Just because we're on title, we're not going to run the property. We're not going to collect rents. We'll never physically be at the property or on site, so somebody has to run that property while we're on title. So it's done through a triple net lease with the exchanger. And they manage the property. They'll supervise any improvements because they're managing it for us. They can also act as a contractor to build on the property. So if there's any construction to be done while we're on title, the exchanger will be the overseer of that construction. Now, there are two types of reverses I've talked about, and we don't really have the time to go into a lot of detail, but essentially if there's a lender involved on the new property and it's a major lender, it's a Chase Bank, it's a Wells Fargo, they probably won't let us be the title holder on the new property. So it usually requires seller financing or a client that has the ability to buy a piece of property for cash. If that's the case, if it's Chase Bank, then we're going to have to go on title to the property to be sold. There has to be insurance to cover the accommodation title holder. We have to be named as an also insured on the policy. We talk about that with each individual client. And obviously this is not for somebody that doesn't have some financial strength, because it's expensive and it's more complicated. How does a reverse work? For time's sake, we're going to quickly walk through one form of reverse, what we call the reverse A, because that's the more typical, where we actually buy and warehouse the new property. So if you'll remember in our delayed slide earlier on, when we simply sold a property and bought another property, this is phase 2. This is how you begin with a reverse. The exchanger is our bank. They have to loan us the down payment to buy and go on title to the replacement property. And that's why it requires either a very sophisticated client who can use their own bank because they have a strong banking relationship, or the seller's willing to carry for up to 180 days, or our client can collateralize a loan with a different piece of property. But essentially the exchanger loans us the money, we buy and go on title to the replacement property. The 180-day period now begins. Sometimes our client doesn't even know what they're going to sell. They may have multiple properties they'd like to sell. They just are very anxious to buy the replacement property. So they, within 45 days, will have to tell us which of their properties they're going to sell. The same 45-day, 180-day rules we saw earlier with the normal delayed exchange. But in this example, instead of the deed going directly between the seller and the client, the seller is going to deed the property to the accommodation title holder. So we actually go on title to the deed. And of course that costs money because you've got recording fees. There will be an actual transfer. There could be transfer taxes. The closing company is going to charge. So there's one set of closing charges that a client would pay. What will happen within 180 days, the client is now going to find a buyer for their relinquished property. That buyer steps in with cash. The exchanger calls us and says, I have a buyer for my property I was trying to sell. We come back as the intermediary with the exchange documents and the instructions, tell the closer to go ahead and sell this property to the buyer and move the cash over to the new closing, which is the closing taking us off title and giving the new property back to the client. That's how the client will get their cash back. They've made an advance to us, but when we deed the replacement property back to the exchanger to finish the exchange, we have to pay off our lender, and our lender is the exchanger. So at that point, the exchanger either can take out a new loan or they will assume whatever financing is in place while we're entitled to the property. I'd like to stop and see if there are any questions at this point. I know I've gone through this awfully fast.
I don't see any questions there. I do have one lingering from what we talked about deposits before. If
okay.
You could maybe answer that one.
Sure.
May a seller, may seller's funds be placed in a trust or an IRA, and then the trust or the IRA investment in like-kind product?
It depends on how that's set up. There are, what are they called? I'm trying to think of it. There are companies that specialize in real estate related IRAs. That's not something that our company does. So when we're working with a client, the money goes into a trust account which we set up, which is simply a parking account, if you will, to be used to buy other real estate. So if the person asking that question is interested in using a Roth IRA or buying real estate through their trust or IRA, they can contact me separately, and I'll try to give them a couple of names of companies that could probably help them with that.
Excellent. That sort of went back to the deposits. I don't see any questions on the reverse exchange, but that was one of the ones that went back to the actual deposit monies.
Gotcha. Well, let me finish then, if I may, before I open up for any further questions, with the actual case study of how the reverse worked for one of our clients. Gattos Corporation develops and owns commercial real estate, apartment buildings, shopping centers, and they were located in a small city. And after years of negotiations, a city agency offered them an abandoned site if they would develop, because they were also a very well-respected developer. And the city made a deal with them that they would sell it for $1 and carry financing if our client would close in 30 days and develop it to get rid of this blighted area, but the city funding would expire in 12 months, and then they would have to refinance it. Well, the client hadn't sold anything yet, but this was an opportunity that they felt was too good to pass up, so they contacted us and said, we would like to do a reverse construction exchange, because they knew they only had 12 months to get something built on it so they would be able to refinance. When they approached us, they loaned us $20,000, which essentially was $1 for the city property, and $19,000 worth of closing costs, because you have to pay your title and your closing and attorney's fees, etc. And we went on title to the city property. Then the capital improvements started, and of course we all know that we've only got 180 days to get the value up. And within the 180 days, the client had the ability to go back and sell one of their properties that they used to continue the funding for the construction on the new property. We built the property up into a substantial value, and it was far enough along that they were able to talk to lenders about a takeout loan within the 12-month period. And of course, when we deeded the property back, it was substantially improved from the sort of tear-down situation that the city had delivered to the client. So just in summary, we're not trying to teach anybody how to do a reverse or even a construction exchange. We just want people to know that this is a tool that can be used, and you can do combinations, because the problem is always to be able to make sure that an investor who is trying to move their money or change their type of investment is able to use every tool at their resource to get into a different kind of property than they own. Maybe they want to go from raw land into improved property. Maybe they want to buy a hotel or motel location that needs substantial improvements, and so they can buy for a lesser value and enhance it to make it a more valuable, better cash flow situation. Maybe they own a series of rental properties and they'd like to gradually get out of those and go into one larger property. Combinations of these exchanges can be used to help satisfy and comply with the regulations. So in summary, again, what is an exchange? It's simply a tax thing. It's legal. It's in the IRS tax code. It's on investment property. We've talked about how broad that description is, because real estate is a vehicle that will take you anywhere you want to go if you buy the right real estate. And this is a way to protect your equity and defer the taxes and move your money into a different type of investment property, whether it's a better location for you, whether it gives you a more substantial cash flow, whether you think it's going to appreciate more. That's what 1031 is about. It has to be done in a very strict time frame, and you've got to go back into equal or greater value, but you don't have to go into one property. You could go into multiple properties. And exchanges can be combinations to satisfy these rules. So unless somebody has a question for me, that is essentially the basics about exchanges. They've become increasingly popular as the seller's market has heated up. We're seeing a lot of more complex exchanges because the seller's market is getting more competitive. Seems like there's a lot more investors' money chasing fewer product. Maybe one of these would be a problem solver for you.
And they really seem to be, you know, a not sort of a one question answer to a lot of these problems. I mean, that's probably one of the reasons why anybody that now is thinking about doing an exchange should, as they're thinking about it and prior to actually having a property for sale, they should come to Starker and make that call to you. You guys do a lot of free advice. One of the questions that is hanging here, you know, what fee does a qualified intermediary charge? And I'm sure that's not an easy question because it depends on all of the exchanges that you talked about. But I don't know how you can to address that, but if you can give us sort of a blanket.
Sure.
Where that would be.
Well, I told one client, Tony, that called, and we hadn't talked to him in 5 or 6 years because he'd gone a little quiet because of the market being a little quiet. And he called back and he said, "What are your fees?" And I said, "Well, this will surprise you, but they've been the same for roughly 20 plus years. It's anywhere from $750 to maybe $1,500 depending on the size of the property for a delayed exchange, and then the banks charge a one-time $100 fee to open the dual signature account." And I said, "But we haven't increased our prices in over 20 years." And he said, "Does that mean you charged too much 20 years ago?" I had to laugh. That was the first time I've heard that that explanation. But if you are talking about a construction or reverse exchange, obviously they become more expensive. There are more closing costs. We pick up the liability of being an accommodation title holder. Our base fee on those is $2,500 plus 0.25% of the value of the property that we're on title to. So that could end up being a $3,000 fee up to $7,000 or $8,000 or even more. We have one client right now that's talking about a $19 million sale. We would have to do custom pricing on that.
Sure. One of the other questions we have is, can you purchase a property for less than your sale price and tax deferred a percent of the equal to the new sale? Basically taking, I think is the question.
Taking some cash, absolutely, you can do a partially tax-deferred exchange. Sometimes clients say, "I need some money out. I have other things I want to do. I want to pay off a home loan. I want to, my son or daughter's getting married." And they say, "I'm not going to put all of my cash back into the next property, or I'm going to go down in value so that I get better return on my investment." And then you would just pay taxes on the difference. One thing we caution people, in all the years I've been in business, we have never seen the IRS or anybody else challenge an investor taking cash out at the beginning of an exchange. So, for example, a client might say, "I'm going to take $20,000 out at the closing table and I'm going to let Starker have the rest and do my exchange." There is a pending tax court case in the state of California, the Franchise Tax Board, where the Franchise Tax Board is trying to disallow an exchange for taking cash at the closing table. Because we haven't access to the case, because it's still pending and the taxpayer is fighting it, we don't know their rationale. So what we're telling clients is, don't take cash out at the closing table where it might endanger the exchange because it shows you getting some receipt of cash. Let us finish the exchange without wiring that $20,000 into the last purchase, and when the exchange is completely over, then we will send the $20,000 back to you, and you would tell your accountant, I have boot, and I'm going to pay taxes on it. We always try to be very, very conservative.
Excellent.
So it's not illegal. We just caution people that, again, the taxing agencies are aggressive right now.
Can you maybe give us an idea? I mean, a lot of us are hoteliers, and you know, part of what we always incur is as you're actually purchasing a property and you're doing an exchange, so you're at the point where you're actually purchasing the property, you're going to have some upfront costs. Like in your exchange, now you have $1 million in your exchange and you're buying a property. How are deposits handled? Can utility deposits, franchise fees, any of those things be paid prior to the actual closing date?
A good question. The only expenses the IRS allows you to pay for with exchange proceeds are non-recurring costs of sale or purchase. So unfortunately, deposits and rents are not a non-recurring cost to sell or purchase. They're actually an operating expense. Closing costs, real estate commissions, title fees, recording fees, our fee, those are all costs of sale, a one-time cost of sale. And so when we see that on a settlement statement, if it's a credit, it means our client is buying, it means that they are having to bring less cash in, which is fine if they're using all of their cash, because remember, we want to do that. On the other hand, on the sales side, if they're being debited those deposits to give them to the buyer, we will caution the client, we will call them and say there are a couple of ways to handle this. It can be done as a POC, paid outside of closing, directly between the parties, or you as the seller can bring that cash in and deposit it at the closing so that there's no deduction. The third option is to call your own accountant and find out if he or she thinks that's going to be taxable to you. You may have capital losses you can use to offset. I've had clients, I have one client who had almost $60,000 worth of deposits and rent prorations, and we called their public accounting firm, and the accounting firm said, we have offsets for that. Don't worry about it. Go ahead and pay it through closing. So it can be different for each client, but it is something that we watch for and try to counsel people on.
That's great. So the best thing is give you guys a call. Again, is my advice. I mean, we've used your company, and that's the best thing I can tell anybody. I mean, you guys are always able to give the advice on where you should go and what you should do and a lot of the tax laws that are out there. We have another question, and
okay.
the question we have is, we are in the process of developing a new hotel and have set up an LLC. We have several potential investors who want to exchange out of real property into their deal. Is there an issue because we are set up as an LLC?
The LLC, I'm assuming, is filing a partnership return. A single-member LLC would not. A multiple-member LLC would file a partnership return. So the question would be, can the LLC sell an undivided interest in the real estate? Because buying a partnership interest is not considered like kind. It's not real property. So the people selling land to invest in this project couldn't sell their real estate and then exchange into a 5% interest in an LLC. As you know, tenancy in common ownership has become really popular, where a group of investors buy larger properties. They actually have to own an undivided interest in the real property for their exchange to qualify. So the LLC could, if they own a piece of property and they want to bring in other investors, the LLC could consider selling, for example, a 10% interest, and they would be a tenant in common with the new money coming in from an exchange.
Interesting. So if there was, and I guess I'm putting a little bit of a spin on this, if there was if I were to start an LLC and I was going to develop a hotel, I had two friends that said, gee, I'd like to be a partner of yours, and they are selling their properties. They have them under contract. They then could find a way then to do an exchange out of their properties into ours, and they could probably be separate identities as LLCs in the third property, right?
Yes. So the LLC, let's say the Tony DeGeorge LLC owns a piece of property and they want to sell to the Rochelle Stone LLC. Rochelle Stone LLC is now going to be a 10% owner in that project. Now, the advantage to that is, let's say, I tell people there are two types of partnerships, new ones and bad ones, because invariably partnerships can have problems down the road where investors' goals change, people die, one party wants to sell, the other one does not. The advantage of having undivided interests in a larger property is if Rochelle Stone turns out to be a rascal and Tony is tired of having to deal with her on this property that we own together, he can tell Rochelle Stone LLC, we're buying you out. So we're going to purchase your 10% of this property, but we'll give you the opportunity to go find a replacement property so you don't have to pay taxes. You can do an exchange out of your 10% into another piece of property, and you can get rid of me without causing problems for either you or me. That's not true of partners in a partnership just splitting up a partnership. We talked about that earlier.
Right. Well, I appreciate you coming. It's been a pleasure. I mean, every time I've been to any of your conferences and anything that you've participated in where I've been there, I mean, I've always learned something, and again today I've come away learning things. So I certainly appreciate everything you've done. And if anybody does have any questions or wanted to receive any information, certainly you can contact us and Rochelle, and know that we actually will be posting this webcast on HBI Live, so within 24 hours it will be there. So Rochelle, thank you again for all of your help in answering the questions and doing this for us. And I do want to remind everyone to please rate today's webcast by clicking on the rate, which is found on the gray bar at the top of the webcast. You can also download a PDF file today of the hotels that you saw at the beginning, which were new listings from HBI brokers, and also additional hotel investments listed by HBI brokers are under the attachment button at the top of the webcast. A quick reminder, we're going to have another Hotel Investor Marketplace webcast like this one that will be coming up very soon. That one will be November 12th, which will feature attorney Clifford Davison. He'll be discussing when hospitality professionals should respond to negative comments, online reviews, and how they can do so effectively. So that may be another one again on November 12th to look at. Rochelle, I'm betting you guys are going to be at the lodging conference. Is that correct?
I'm not sure if we are or not. I'm embarrassed to say I don't have my calendar in front of me.
That's okay. Well, what I will tell everybody, usually Rochelle is there, or a representative from Starker is there. But in any case, we expect to be, we will be hosting a booth at the lodging conference, which is coming up on October 20th through the 23rd. We'll also be at the IHG show at the Sands Expo Center in Las Vegas on October 27th and 29th. And if anyone's attending, please contact us and let us know you're going to be there. And if there's anything we can help you with, it would be great. I have one last question for Rochelle that snuck in here, and I don't want to pass up the opportunity. So can you sell 2 properties for a lower price and exchange into a higher price one? And that'll be our last question for today.
Absolutely. The government always lets you add cash into the transaction. It's when you take cash out or go down in value that they are concerned. So many times people are selling smaller properties so they can leverage into a bigger property and they bring in more cash. Perfectly acceptable.
Cash is never a problem.
Cash is never a problem.
All right. We appreciate everyone that has viewed this webcast, and will, if anything is needed as far as notes and things like that, know that it is available, will be posted on HBI on our live section. And again, Rochelle, a pleasure, and I look forward to seeing you very soon. Thank you, everybody.
Thank you, Tony. I always enjoy it.
Thank you. And we will see everybody very soon. Thank you.